All right, good afternoon, everyone. Thank you for joining our webinar about employer and individual retirement plans. We're going to discuss the benefits of and differences between employer retirement plans and individual retirement plans, kind of touching on some basic components of each. And we're going to discuss the case for investing in real estate and private debt in retirement plans. Okay, my name is BDavis. I'm a senior vice president here at the Exeter group of companies. And in particular, I work with Exeter Trust Company. So a little bit about Exeter Trust Company. Okay, so we are an independent trust company. We have a Wyoming banking charter through the Commissioner of Banking here in Wyoming. We're licensed, regulated, and audited by the commissioner. And that means a few things. That means that our transactions must be transparent, our actions must be transparent, and we're regulated and audited every 2 years, a very rigorous schedule. That means we have to be truthful in our business. It also means that we have access to a database of hundreds of best practices from other banking entities in the state that we could draft off of and make sure that we're performing in the same manner that every other banking entity is. So that's a very powerful tool being regulated. We also have insurance coverage, fidelity bond coverage, errors and omissions insurance. We have an institutional blanket bond, and basically, along with the fact that we're regulated, we are a very safe, independent trust company. So when I think about the Exeter group of companies, I think about two flagship products that we have. The first is our heritage. We are a qualified intermediary for 1031 real estate exchanges. We've been doing that for quite a long time. The other flagship business we have is specific to our trust company. We offer self-directed IRAs and single participant 401k retirement plans, including employer retirement plans. And our core competency with those plans is that we are very good at holding and executing purchases of alternative investments. These are things like real estate, promissory notes, private stock, private bonds, private funds, things that you cannot acquire over an exchange. And that is one of our good core competencies. We also act as directed trustee or administrative trustee for Wyoming trusts that need a directed or administrative trustee. So that is another line of our business. And then we also hold specialty trusts. These are things like title holding trusts and specialty escrow accounts. So we are a pretty specialized banking entity when I think about our lines of business. Right, so our webinar today is focused on two things, retirement plans and real estate and debt investments in IRAs, right? So I have some goals for our retirement plan discussion, and I want to give you really the basics that you need to go when you're thinking about purchasing alternative investments in IRAs, in particular, employer-sponsored retirement plans. So those are the type of plans that we'll focus on. So I want to differentiate employer retirement plans via four lenses. I want you to walk away with who can open a plan, who can contribute, and how much can be contributed to those plans. I want you to walk away with who can receive tax deductions versus contributions, which is hugely important for employers who are sponsoring retirement plans, but also important for employees. I want to go over some special features, and these are maybe opinionated, but most people will agree these special features are important to the three main plans that we'll talk about. And then what I hope you walk away with in addition is the best fits by employer type. What's good for a contractor? What's a good retirement plan for a LLC with 50 employees? What's a good plan for a sole proprietor? So it's a very important decision to make up front, based on complexity of the plan and what your accountant is expecting from you. We are also going to summarize individual account types. I won't get into too much detail about traditional IRAs and Roth IRAs, but I'll summarize them and link them back a little bit to employer-sponsored retirement plans, because there is an important link you need to be aware of when thinking through the process of adopting an employer plan. We'll talk about who can contribute and how much. We'll talk about who can deduct as far as individual retirement plans go. And then I'm hoping to illustrate a good, strong case for you as to why real estate and private debt should be part of a retirement plan portfolio, whether that's an individual retirement plan like an IRA or a Roth, or one of the employer-sponsored retirement plans. Okay. Next slide, please. Plan types. So these are the plan types we're going to talk about, and these are the array of plans that you as an employer or you as a person recommending a plan type to an employer have to choose from. Single participant 401ks. These are the cousin of the 401k that we all know, the big corporate 401ks that are supported by most of the large corporations domestically. There are a few different nuances to these that make them unique, but they are very much like, and they behave very much like the typical corporate 401k plan. Simplified Employee Pension Plan, SEP. SEPs have gone out of style a little bit lately. We don't see too many SEPs opened anymore, but I am a huge fan of SEPs, and I think that with the right employer and the right employer structure, SEPs make a lot of sense. They're simple, and you can get a lot of money socked away into them. So SEPs are a good plan, and I'm going to illustrate why in a bit. Simple IRAs are another plan that look a little bit like a 401k, but they are vastly less expensive, right? And they're less complex as far as plan testing goes. They're a little more rigid, though, than their second cousin, the 401k plan, right? And then I want you to be aware of some other plans out there in the world. These are plans that we won't talk too much about today, but you need to be aware of them. The first is defined contribution plans. These are profit sharing plans, money purchase plans, and 401ks. They are typically adopted by large employers. There are defined benefit plans. These are plans that are very, very rare anymore. They used to be voluminous. My father, who worked for United Airlines for 40 years, had a defined benefit plan, and it basically covered his retirement until his death. So very rare, those plans. And then there's government plans and thrift savings plans for employees of the government and for our military personnel. The reason I mention these plans is because there is a lot of portability anymore between plan types. If you leave one employer, go to another, and the plan is different, chances are you can move your investments or money as they are from one plan to the other. And that goes for our two individual plan types, traditional IRAs and Roth IRAs as well. The portability anymore between those and employer plans and between those amongst themselves, very flexible. So what I want you to walk away from that commentary with is that if you leave an employer to go to another employer, or if you close down one of your businesses and open another one, very possible you can transfer your plan from one place to the other without a problem. Okay, let's keep that in mind. All right, let's dig in. So who can make contributions to the employer-sponsored retirement plans? And we are going to talk about the top three plans: the single participant 401k, the SEP, and the simple. We'll start with the single participant 401k. So there's three streams of contribution that are possible. Two from the employer, one from the employee. The two streams of contribution from the employer are in the form of a profit sharing contribution. So if you have a great year, you can make a contribution for X amount. And we'll talk about the amounts as we go through the presentation in a second here. The second stream of contribution from the employer is in the form of matching contributions, and that's matching the third stream, what the employee defers from their paychecks. Right? So the employer has the opportunity to make both the profit sharing contribution and the matching contribution. They're not limited between one or the other, right? So three streams of contribution can go into single participant 401ks. Now, you might be thinking, well, I'm the only guy in my company. I'm a sole proprietor. I'm my only employee. I don't rely on anyone else. Well, you're wearing two hats here. You are the employer and the employee. And that's important to remember because you have all these streams of income that you can look at and make contributions with. And between you and your accountant, you can probably maximize your contribution based on the revenue of your company. So it's very important to remember. If you wear two hats, you're always the employee and always the employer. Okay, let's move on to a SEP. I love SEPs again. SEPs are simple. There is one stream of contribution possible for a SEP IRA, and that comes from the employer, an employer profit sharing contribution on behalf of the employees. The employees don't have any say in making their own contributions, deferring salaries, or anything else. Good and bad to this, right? If you have 50 employees, they expect to participate in your retirement plan, and you have a bad year, it might be a poor scene. However, if you are a sole proprietor, if you're a contractor, that you have your own business, or you have just very few employees, this is a great plan because you make an elective deferral for this contribution based on income. If you have a great year, make a heavy contribution. If you have a poor year, you're not locked into making any type of contribution. So SEPs are very flexible for small employers and for single person employers like contractors and sole proprietors. Very powerful plan. Further, they're simple. Your accountant will thank you for opening one if you're the only person involved in your company. All right, the second cousin to 401k plans, the simple IRA. Three possible contribution streams. First of all, the employer can contribute in the form of matching contributions, right? So the employer can make salary deferrals, and then the employer can match those salary deferrals up to a certain percentage. We'll talk about that percentage in a moment. Or the employer, and this is the second stream of contribution, can make contributions in the form of a non-elective contribution, a profit sharing, up to 2 or 3% of compensation. So they have to make a choice, right? So there's three possible contribution streams, but two that actually happen, all right? And I want to reflect again, the employer has to make a choice. They can either make matching contributions to what their employees are deferring from each paycheck, or they can make roughly a profit sharing contribution to each employee based on profits. All right, let's move on. Next slide, please. All right, I promised talking about contribution limits. So here's what you have to pay attention to with single participant 401k plans. You can sock away a lot, but there is a limit to it. And there's actually two limits, all right? So as an employee, 24,500 per year or 100% of compensation, the lesser of which can go into the plan, right? So as a highly paid employee, you can get a lot of money into a single participant 401k. But then you have the employer matching or profit sharing contributions to contend with as well. And the annual additions limit for a plan in general for an individual is 72,000 or 100% of compensation, the lesser of which, right? So 72,000 is basically as much as you can get into a single participant 401k. Now that's a lot of money for a lot of us, right? It's very rare that people anymore max out any of their retirement plan types, but that is the maximum between employer and employee contributions. SEP, similar, $72,000 maximum. And remember, with a SEP, the only stream of contribution is coming from the employer. You are wearing both hats if you're the only person involved in the company. And you are wearing the employer hat with a SEP, not the employee. So $72,000 maximum contribution and up to 25% of total compensation. All right. So depending on how much you make, it could be less than 72,000, but still a heck of a lot of money to sock away into a retirement plan, if you run your own business. That's why I love SEPs. All right, simples, not as simple as one thinks. So with simples, you can do 17,000 in employee deferrals, and then the employer matching can be up to 3%, or in the case of a non-elective contribution, 2% of compensation. All right, so a little more rigid than the single participant 401k, but as we'll see in a bit, a lot less expensive. Okay. And then traditional IRAs and Roth IRAs, I promised you that I would touch on these, although I suspect many of you already have these type of accounts and are probably more focused on the employer type plans, since that's how we marketed this. For 2026, traditional IRA, Roth IRA contribution limits are for anyone under the age of 50, $7,500. Okay, with some phase out limits. And if you're age 50 or older, you can catch that up. You get to contribute just a little more, 8,600 per year. All right. Next slide, please. Okay, deductibility. So, okay, there we go. Catch-up contributions. All right, I also want to talk about catch-up contributions for employer-sponsored plans. We talked briefly just now about the age 50 and older catch-up contributions for individual IRAs and Roths. Employer plans also have the catch-up. For employees 50 or older, it's $8,000. And for employees 60 to 63, 11,250. And that's above the limit. So those are very good ways for people who are just participating, just starting to participate in employer-sponsored plans for whatever reason, and you're a little older. All right. Next slide, please. There we go. All right. So what I hope you're thinking about now in your head is, wow, okay, so I'm a sole proprietor. I know how much I can contribute. That's a lot to put in plans. And I know what plan is starting to look kind of good for me. Let's talk about deduction as an employer and in the individual plans as an individual. So deductions are a powerful tool as well. You don't only get the benefit of putting money in a retirement plan and having it grow tax deferred until you take a distribution 40 years down the line at retirement. You also get the benefit of deductions as an employee and as an employer. So for the single participant 401k, employer amounts contributed are deductible to the employer. So that's money off their taxes. It's also employee deductible, meaning that it reduces their taxable income by the amount that they contribute, if made on a pre-tax basis. All right. SEP IRAs, again, one hat here, employer. Employer contribution is fully deductible. with some exceptions. So whatever is put into the plan, the employer gets to take off their taxes, right? Simple IRAs, very similar. The employer matching or non-elective contributions are tax deductible, and the employee deferrals reduce the employee's income, so also deductible. Um, very good tools on both the incoming and outgoing side of the plan to engage employees in the process of saving for retirement, right? Okay, individual plans. People select individual plans anymore kind of based on buzz in the news. And what I've seen and what a lot of people have commented on is that, well, Roth IRAs are good for young people. Traditional IRAs are for old people. That is a poor way to approach this, right? I tend to approach more from the idea of deductibility. Um, a traditional IRA has the upfront deduction. You can deduct it on your taxes. You make a $7,500 contribution with some exceptions and phase out ranges, you will probably be able to deduct that entire amount from your taxes. And if you need the deduction, it's a good tool to use. Roth IRAs are upfront taxable, so you don't get the deduction, but you don't have to pay taxes when you take a distribution 40 years down the line. Now, the other argument around that is that, well, 40 years is a long time. How do I know if I'm going to be in a higher income tax bracket or a lower income tax bracket? How do I know what the tax brackets are actually going to look like or if they exist? Well, you don't. Projecting that into the future is also kind of a poor way to go about this. So I reflect back on number one, are you contributing into a individual retirement plan? That's the first most important factor here. Making a contribution, whatever you can, into a plan consistently every year will be great. All right. And the second thing to look at here is, well, do you need a deduction this year and you already have a Roth? Maybe you open a traditional IRA to get use of the deduction. Okay. Nothing says you can't have both a Roth IRA and a traditional IRA at the same time. Right. So that's my take on individual plans. Now, there are phase out ranges for participating in traditional IRAs and Roth IRAs and making contributions based on a couple of factors. The first factor is, do you have an employer sponsored plan and how are you funding it? Um, the second factor is, how much money do you make and how do you file your taxes? Those are kind of advanced topics with a lot of numbers behind them. And I would urge anyone ready to do this to call me and we can walk through the numbers. But they're kind of beyond the scope of this presentation. I want you aware of those phase out ranges. I want you aware of the connection between those and the individual plans and the employer plans. But I don't want you to focus on, well, what is that phase out range right now and what percentage of my income can apply to it, right? That's beyond the scope of this conversation, but keep it in your head. Okay, next slide. All right. So back one. There we go. Perfect. All right. So what you should be thinking now is, wow, SEP IRA looks good for me, or simple IRA looks good for me to recommend to this employer I'm doing business with. And this is why. Um, I've got the contribution amounts down. I know how they're deductible. I know what applies to a company with 100 employees, what might apply to my sole proprietor over here or my contractor over here. Now, these are some special features I'm going to talk about that kind of tip the process over into one plan or the next for people who are on the fence about one or the other. Um, back one slide to the special features slide. Thank you. Okay, so single participant 401k, the first cousin of the corporate 401k. Contributions can be made pre-tax and post-tax, depending on your plan document. So you can have a Roth contribution. Post-tax contributions go into a single participant 401k if your plan document allows it. Um, Typically, we don't see much of that, but I made this comment earlier. We shouldn't base our facts on this, but many young people do the Roth contribution to the single participant 401k. Okay. Um, there is no age restriction on contributions, though. Okay. And when I say no age restriction, if I'm 95 years old and I'm running my company and I have a single participant 401k, I can make a contribution. I could be 100 and make a contribution. Now, required minimum distributions still come into play. I have to take money out once I reach age 73. However, there's no age restrictions on contributions. That's a great thing. It's a great estate planning vehicle if you take your entire context into play. And then finally, there is a loan feature with single participant 401ks, much like the loan feature with large corporate 401ks, right? The loan feature is 50,000 or 50% of your vested plan balance. And it could be a lot, right? Depending on how long you've participated in the plan. The conventional wisdom in retirement planning says don't take money out in any manner whatsoever unless you absolutely have to before retirement. In my opinion, that goes for loans as well. Typically shouldn't take a loan out to go buy a Porsche. I mean, you have to pay the loan back anyways to your plan, but for frivolous expenses, that's really not what the loan provision is there for. Loan provision is generally for emergencies that aren't covered by the distribution penalty exceptions out there from the IRS. Okay, so take this with a grain of salt. There is a loan provision. It gives some flexibility to employees, but should be used sparingly. All right. SEP, simplicity, great for self-employed individuals, and I've talked about this 3 times now. Sole proprietors, contractors, people who have 1 or 2 employees and aren't worried about, the fact that their business is going to make money or not make money. Those are good, solid employers put into a SEP plan. It's a low maintenance plan. Accountants love SEPs. They're easy to report and they're easy to run. They're also low cost. Typically, with most financial firms, SEPs cost the same thing as a traditional IRA. So they're great vehicles. Simple IRAs, again, the second cousin of the 401k. It's a toned down 401k. They're good for small employers, 100 or fewer employees who desire employee engagement in retirement. And that means you can use a simple to engage people. It's an HR tool, right? Because your employees have the benefit to make salary deferrals and participate in their retirement. The SEP plan doesn't allow that, right? It's all on you as an employer. If you have a good year, you make a contribution. If you have a bad year, you don't. There's no way to engage the employee in participating in a SEP. But in a simple, it's an HR plan. You can engage the employee, they can participate, and then you can show their worth by making either profit sharing contribution or matching their salary deferrals up to 2 or 3%. Okay, so that's the key with simple IRAs. Further, there's immediate vesting. It's all their money immediately. So employees don't have to worry about, well, what if I leave after 2 years and I've got 10,000 locked up in this plan? Is it really my money or does it go back into the pool? It's immediate vesting, so it's all their money. Finally, I want to go back to cost, and cost shouldn't be the only factor that you take into consideration, but like the SEP IRA, simples are much less expensive than your typical corporate 401k plan for multiple individuals. There's less testing, a lot of testing with the 401k plan. So firms don't have to charge as much. You can go just about anywhere, a mutual fund company, an insurance house, trust company. and get a low price, inexpensive, simple IRA plan for a set of employees. So it's a very good plan, low maintenance, low cost, immediate vesting, and good for small employers. So at this point, you know a lot about the basics, right? I think I've given you the basic understanding of what plans might make sense for your business. The other thing that I hope is in the back of your mind now that we're going to bring to the forefront of it is alternative investments, right? So we all know we can invest in the markets. Everybody's in and out of the market all day long. eBay reported earnings went sky high, then dipped today. Crazy stuff goes on with the markets. The markets are not your only alternative for investment in retirement plans. Alternative investments are a great alternative, and they span across a lot of things. What the IRS says is that there's a few investments that you cannot invest in a retirement plan. Collectibles, it's one. Certain commodities are another. Life insurance contracts, S corporation shares. There's very few of them. There's one other. Very few things that they say you cannot invest in. Instead, they say there's people, there's individuals, and there's prohibited transactions that your IRA cannot embark upon or do business with. Okay. Who those individuals are and what those transactions are outside the scope of this, but I would love to talk to you on an individual basis about them. So afterward, we can also field some questions around those if you have them. But what I want to get into now is the possibility and a compelling story for why you might want to utilize real estate and private debt in retirement plans. Next slide, please. Okay. So what types of real estate and private debt can I hold in an IRA or an employer-sponsored retirement plan? A lot of this depends on your plan sponsor and who custodies your plan. We're going to assume that it's a trust company like us, okay? So real estate, you can hold in IRAs. Now, many of you maybe have purchased a real estate investment trust through your broker dealer into an IRA, and that's not what I'm talking about. So the first type of property that you can hold in IRA is property on the ground, a piece of real property, retail dwellings for long-term or short-term lease or rents, actual house. Commercial properties such as strip malls and warehouses are also a possibility. Raw land, perhaps it's a piece of raw land for speculation, which you think is going to go up in value over the next few years, and your IRA could make a great profit off of it. Raw land is also a possibility to purchase into an IRA. Development, game, and mineral production off that raw land is also a possibility for income generated by the property and coming into your plan. All right. So pretty flexible as far as what a retirement plan can invest into in the real estate world, right? But I want to make an important statement here. Successful serial real estate investors, those investors who are out there who have done this over and over and become successful at it, have a system. They have a process. They have tools that they use to identify the properties. You can just as easily buy a bad property that fails as you can buy a good property if you don't have a plan and if you don't have a system. There's a lot of people who sell systems out there. There's a lot of good people who talk about their systems. Have a system in place before you embark upon the real estate process with an IRA. Now, there's other types of real estate derivative investments that are considered alternative investments that can also be held in IRAs, and these are just exciting as real property. Delaware statutory trusts are a possibility for purchase into an IRA. Now, there's some tax ramifications that might be problematic and a little complex to deal with, but DSTs are a possibility. Private REITs, and I'm not talking about a REIT that you can buy over an exchange. Private and non-traded public REITs are also a possibility. Private real estate funds are also possible. Last I looked 2 months ago, there are over 7,000 private real estate funds out there for investment into. And these are funds that you have to dig a little bit to get to. They utilize Regulation D to avoid reporting to the Securities Exchange Commission and having to do all of the paper reporting that's required of a large fund. So these are smaller funds. They utilize Reg D, but they have autonomous, active, engaged professional real estate managers managing them. So if you're just now splashing into real estate as a possible investment, this might be a good way to start. Right? It's good exposure to real estate. You have a professional manager managing the investment. Right? Let's talk about debt on the other side. And I relate debt to real estate because you can loan from an IRA. And sounds surprising. Some of you are probably thinking, I thought I could only take a loan from my 401k. We're talking about making a loan as an investment to an individual out there in the world, or a company or an institution out there in the world. Loans are possible from IRAs, and it's possible to take back security on that loan. So let's say you loan to an individual who owns a house, they need the money, and they put up their house as security for that loan, for their payment stream. It's called a deed of trust, and your IRA ends up holding investment in a deed of trust, and then collects the income from that individual. So that's one form of debt. Other forms of debt, unsecured promissory note. Many people approach that as a very risky investment. It depends on your borrower and what you feel your borrower is going to do. Again, good to have a process, tools, and a system in place for this type of thing. Convertible debt. Perhaps there is a company in your town. They're a startup company. You know they're going to do well, and they need funding. You could structure a loan to them with terms being, when you do issue stock, my loan converts to stock in the company at a discount price, right? So if they're doing well and they're making payments into your account based on the loan, and then they are ready to issue shares, you can buy at a discount and they continue to improve. It's a great investment. Finally, simple agreements in future equity, safes. Over the last 10 or so years, safes have become very popular. They were made popular by a company called Y Combinator, who is kind of a collective of people who get together and look at angel investors and private investments. A safe is roughly an unsecured note to receive shares of a company if it issues shares, close to founders shares. All right, so that's there are also funds, Reg D funds that invest in debt. Right, so these are all the myriad of possible investments into real estate and private debt. I want to talk in more detail about real estate because it is popular, and I'm going to paint a very compelling picture in a few minutes about why real estate makes a lot of sense. So your next question is, well, how does this whole real estate thing work? How do I get a piece of real estate into my IRA? Next slide, please. All right. So it's a bit more complicated than buying a stock on an exchange, but we have it down to a process, as many other independent trustees do for IRAs. There's a few very important points here that I want to make. So the purchase from your IRA, the initial step is to identify property, and then you provide the offer letter. Typically, your IRA will sign off on that, and that's us as your custodian. And then you set up an escrow, generate the paperwork. The paperwork, closing statement, the contract, everything should be signed not by you as the owner of the IRA, but as the custodian of the IRA, which ensures that it will be registered in the proper name of your IRA. It also ensures that it will be a non-reportable tax event by using the custodian's tax identification number. Okay. So all of the paperwork comes to the custodian from the escrow. Custodian executes at your direction. Most custodians will expect you to sign off on most of the pages as well. And then your custodian will send the money out of your IRA to the escrow. And that's the second step here, the company that looks like the Lincoln Memorial. That is your escrow. Money sitting there, it goes to the seller, and the title company registers the shares. And this is utterly important. Exeter Trust Company custodian for benefit of the client's traditional IRA. That is what makes this an IRA investment. The combination of money moving from the IRA, bypassing your hands as the holder into the escrow, and the title company registering it properly. That is what makes it an investment in the IRA. Okay. And then companies like us will reflect it as a position on your statement. Okay. But things happen with real estate, right? If it's an income producing house that you're renting out to individuals, well, the roof may come off. Okay. Or a window may get broken. Maintenance happens. Repairs happens. Sometimes you want to upgrade. Any money that is used to fix a house that's held in an IRA, or a piece of property that's held in an IRA, or to maintain it, must come from funds in the IRA. You cannot use individual funds or funds outside of the IRA to do this. Has to be funds in the IRA. Okay. Otherwise, it jeopardizes the whole qualified component of your account. And disgorgement from an IRA is not a pretty thing. It's very expensive and penalized. All right. So, in the forefront of your mind, you should be thinking, money should never touch my hands. It comes from the IRA to fix the house. On the flip side, that house is probably earning rent. Otherwise, what's the purpose? Rent must bypass you as well. It must come from the renters directly to either the custodian, which is us, Exeter Trust Company, or to a property manager, which you name, and then forward it on to the custodian. One house, probably easy for individuals to pay the custodian directly. We kind of discourage that. But multiple houses, typical, you should have a property manager, someone other than yourself. Again, that's touching IRA money, being involved in the maintenance of your IRA is off limits for the IRA owner. All right. So this is how it's done. This is a good graphic. It's going to be on our website. And this is how you actually purchase and maintain a piece of real property, a piece of property on the ground out there in your account. So I'm moving on to your next line of thought. Your next line of thought is, wow, I know what retirement plan I want to go into. I know how to make a contribution. I know where I'm going to move money from, and dormant plan out here that I used to work for. And I know I want to do a piece of real estate. But why? Why would I want to do that when I can just invest in a bunch of mutual funds or an annuity contract or, stocks? I will tell you why. Next slide, please. All right. So I'm going to back into this conversation a little bit. In 2018, 2019, the Federal Reserve reached out to a gentleman named Oscar Jorda, and they asked him to put together a team and do some research for them. They wanted to know what the average annual return of all the asset classes is over time. Right? Now, that's a pretty broad and daunting task. Right? But they did it, and Oscar was successful at it. And he produced a report. I kid you not, the rate of return on everything, thick report, 1870 to 2015. Oscar Jorda and his team was able to find returns on the four asset classes, the four main asset classes, back to 1870, but not just for the United States, for multiple countries. France, Britain, 14 different countries. All right. So that makes it a very inclusive study. And in the end, what he found was something that was surprising. The fact that treasuries return around 1.5% from 1870 to 2015 across 14 countries didn't surprise anyone, right? Treasuries are supposed to be safe, low income investments, with, again, the operative word safe. Government bonds didn't surprise anyone, turning around 2.5%, over all those years. And equities they knew would fly high. Equities returned around 7%. What surprised everyone was that real estate outpaced from 1870 to 2015 for the long run. Real estate outpaced equities, and equities are public securities that you can buy into in the markets. That surprised everyone. So real estate is actually a point above, in Jorda's study, equities, right? So next slide. Why invest in real estate in your retirement plan? Well, first of all, it behaves and returns similar amounts, if you get the right piece of property, to equities, right? Second idea is that, well, that's further diversification potential. And in the financial planning community, in your CPA community, in the legal community, we talk about diversification ad nauseum, right? Diversification is one of the most important concepts for investment in your retirement plan. So further asset diversification is a big factor in why you should have actual real estate or real estate derivative alternative investments in your retirement plan. Further, real estate on the ground is not necessarily correlated to the markets, to the S&P, to the NASDAQ, to the Dow components. It's not correlated to those. It moves in its own manner. So lack of correlation is good, because when the market's going down, your real estate is still moving in a particular direction. Flip side, if your real estate's failing a little bit, perhaps the market is moving in an up direction. All right, so that's the key behind diversification and why you want a lot of it. All right. Further, real estate has demonstrated, based on its average return, that over the long term, it appreciates, and it has a lot of appreciation. So if you use your tools that you generate and your processes as you should, and you back test them, you can find the right real estate that does this for you. Finally, real estate on the ground has a variant of outcome. You can do a lot of different things with real estate. You can rent, you can lease it. That goes for raw land and for property with structures on it. You can utilize tools out there through your property manager, Airbnb, VRBO. Use those to rent out a piece of vacation property, right? Multitude of other tools out there that your property manager can utilize to manage the piece of real estate in your IRA. You can sell the property down the line for a profit. The money comes back to your IRA, remains tax deferred, just like selling a stock, okay? You can improve the property. You can buy a dilapidated piece of property, and as long as you improve it with money from your IRA, you can sell it for a higher price down the line. And then, finally, if you're at a point in time where you're ready to start taking value from your accounts and you need to distribute something from your IRA, and really all you have is a property in there, you can actually take a distribution of a piece of real estate into your own name. It is taxed, could be penalized if you're under 59.5, but it is possible to take a distribution. It goes in reverse from the process I outlined earlier. The title would be removed from Exeter Trust Company as your custodian, and it would be placed in your name as an individual and taxed at that point if it's coming from a traditional IRA. All right, so a lot you can do with real estate. Again, I'm going to go back to my last bullet point here. Utilization of a model is important to its success, though. You must have tools in place to select the right property, to select a robust and high quality property. All right. I want to talk about the final factor with real estate, which makes it a compelling investment to diversify your portfolio with. Next slide, please. All right. So you're looking at two curves. One is from France, one is from USA. This is from the same study I referenced earlier, Oscar Jorda's study. And this compares two markets, the public market for REITs, and in France, it's the REIT-related asset that they have over time. But this is the public market for REITs in those countries. The green line, the green curve, is the real estate market, real estate on the ground, actual pieces of property and the price fluctuation. Okay. And what you're going to see is the red line looks like a mountain range. It looks like a stock chart. It goes up and down quick, fast, with a lot of momentum. The green line, green curves, it's a little smoother, right? It doesn't have the peaks and valleys that are so violently in the red curve. Now, this is the returns, okay? And the returns speak to volatility, how hard a particular asset moves up and down and quickly in time. Okay, that is volatility. It's a function of up and down and time factor. Next slide, please. So what Jorda found with real estate is that it has the volatility, the average volatility over the span of 1870 to 2015 that government bonds do. We consider government bonds safe. We consider them non-volatile, low in volatility, as we do treasuries. Real estate was at the same level as government bonds. So what you could say is, they say have the same volatility level, probably the same risk level. Different risk factors, same risk level. Look at equities, 23%, right? We know equities are volatile, those that are traded over exchanges. But the fact that real estate has such a lower volatility than equities surprised everyone in this study. So what you end up with, and this is the most important factor, if you diversify with the right piece of real estate, the right piece of real estate that you identify using back-tested tools, processes, and systems, is an asset that has the same volatility and the same protection as a corporate bond, but the same, if not equal, average return as equities. Why would you not want that in your portfolio, right? I'm going to say that again. The right piece of real estate will give you the same average volatility as government bonds and the same return over the long term as equities. Okay. Great way to diversify. All right, so I hope that you have this compelling idea now in your head that real estate, debt investments, alternative investments are a good way to diversify your portfolio. I'm going to leave you with a few thoughts and then open up the floor to questions. Next slide, please. So as you go through this process, and as you embark upon alternative investment purchases and real estate purchases and build your system, you're going to gain expertise. And I don't want you to be daunted by that. It takes a long time to gain expertise and takes a lot of effort. We all know this. Some people argue 10,000 hours, other people argue more, other people argue a little less, but it's going to take some time. So that's why I urge that you build tools and seek out individuals out there who can help you find those tools and build those systems to identify the right properties. But once you get there, you're going to be an expert. And we know that experts perceive things differently and more quickly than the rest of us in those particular areas, those particular ecosystems. Expert sees things that we don't as non-experts. And you'll be able to identify properties and investments more quickly and to a higher level of quality than you would be when you first started, okay? So take heart, you'll get there. And then finally, you should invest in what you know. If you're an expert already in a particular field, find a way to find investments that apply to that field, that allow you a one-up leg on others in knowledge of that process or that investment. If you're a realtor and you're good at finding rental properties for your clients, why would you not find one for your own IRA, right? Utilize that expertise. Utilize your own expertise to find investments that help you grow your retirement plan. All right. So that's what I have for you today. I hope you found a lot of information useful, and I hope you've kind of hit the basics here. What plans are good for me, and how can I invest in alternatives in those particular plans? So at this point, I want to open up the floor to any questions that might be out there, and you can post them in the chat if you would like. And I don't know that I see any questions at this point, so we'll give it just a few more minutes here. At the end of this presentation, which will be on our website, you do have access to me, phone number, email. We are highly consultative at the Exeter Group of companies. So much so that we love picking up the phone. We have receptionists that seek us out if we're away from our desks, and we like to talk. So if you want to bounce ideas off of us, there is no idea that's crazy. There is no bad idea. We can help you navigate the process of alternative investments and also the pitfalls. There are pitfalls out there I referenced earlier. Be aware. All right, one question. If you take a loan out, is there an opportunity to put it back in without penalties? In a single participant 401k, absolutely. If you take a loan out, you have to pay it back. Otherwise, it becomes a distribution and penalized. So yes, in the plan for a single participant 401k, there is a loan feature. Now, what I'll also throw out there is what people use for loans sometimes. In some cases, people take distributions from their IRAs, and I do not advocate this. I don't advocate taking a distribution from your IRA until you're ready to retire. But people take distributions, and then they have the opportunity to turn back that money into their IRA 60 days down the line. It's called a rollover. You have the ability to do that once a year. That should be used so sparingly and only for real emergency situations that aren't covered by the distribution exceptions that the IRS puts out there. Again, people use that as a loan feature, and others will tell you it's a good way to go. I will not. It's a possibility, extreme emergencies only. Other questions? Okay, I see one come up. What are who are the prohibited people that I can't do business with that you spoke to earlier? So the IRS calls these individuals disqualified individuals. You cannot buy a piece of property into your IRA from yourself. You can't own it. All right, if you already own the property, it's disqualified from being bought into your IRA. You cannot sell a piece of property in your IRA to yourself. You can distribute it, but you can't sell it to yourself. Family members are also disqualified from doing business with your account. In terms of services to your IRA, people providing services to your plan cannot partake of the benefits other than commissions and fees that they would typically charge. So, for instance, if your realtor helps you buy in a property into your IRA and you're going to rent it out as a vacation home, he can't use it for free just because he was your realtor. Okay, things like that the IRS prohibits in terms of alternative investments. Okay, other questions? Okay, that looks like it today. I appreciate everyone listening to me. I hope I painted a compelling picture for the case for real estate and IRAs. You have my contact information here. You have my contact information in this deck, which will be on our website, and I'm all over the website. So I look forward to talking to some of you. Remember, there is no crazy question, so I hope to hear from you. Thank you.